Hello and welcome back to the Expert Exchange. I'm Lindsay Melchek, and back joining me today is Michael Sakuro. Michael is the CEO of Fluent Capital Management and co-founder and president of Spark Financial Group. Well, hello, Michael. It's great to sit and chat with you again.
Great to see you again, Lindsay. I'm always happy to be here and talk.
Okay, so last time we spoke, it was around the time the Canadian government announced their 30-year amortization plan for first-time homebuyers. So you gave us some great information on what that means. And for those that haven't seen that conversation, there's another shameless plug. Head to stockhouse.com to watch it all. But now if we look forward, I want to talk about those buyers whose mortgages are about to come up for renewal. And there are a lot of them. So what is on the horizon for mortgages renewing in 2025?
Well, like we previously spoke about, there's one of the biggest mortgage renewals happening in Canadian history. We have 1.4 trillion mortgages renewing in 2025. So that's first time for us, first time for the market really seeing something as grand as this. And it's really going to affect, a couple different market trends that we're going to see. But again, it's the first time ever. So we don't know where the history lies in the past, how this is actually going to affect the market and the housing market. You have rates that were being cut. So what's that do? That incentivizes buyers to go buy. But then you also have current mortgage holders that are getting worried with the impending rate hike that's coming up with their renewals. So are they going to sell? So it's very it's a tricky time to see where the market's going to be heading soon.
And so what trends and economic indicators should investors be monitoring to anticipate changes in the mortgage market?
Yeah, absolutely. The number one that I always look at on either a weekly basis or at least every other day is looking at the 5-year bond yield. Now, the 5-year bond yield, as I mentioned before, is really just for the fixed rate mortgages, but that helps you indicate where the bank is going to head with their rate increase or decrease. So for us as mortgage brokers, once a week, every Friday, we get our rate updates. And as an example, today, the 5-year bond yield opened up at 3%, and right now it's trending at 2.91 to 2.92. So a rule of thumb is 150 to 200 basis points is where the banks will base their fixed rates. So given that it's hovering around 3% to 2.9, we might get a fixed rate update of around 4.5% by week's end. So that gives you an indication of how rates are moving, which again, the lower the rates are, the better it is when it comes time to renewal, that gap is closed from what the current rate is that clients have from 2020 and 2021, now going into 2025 and 2026.
Okay, what about the risks associated with the upcoming renewals then?
Well, the number one risk there is going back to, look at the history books. 2020, our rates were as low as 1.1. I even did a couple mortgages at 0.99%. So you take someone that has taken a mortgage at, let's say, a 30-year amortization. The rule of thumb there is about 60 to 70% of your payments actually go towards interest in the first 5 years of that amortization. So now fast forward 5 years, let's say they're renewing at 4.5%. They've gone up almost 4% of the last time they've gone up 4% of their mortgage payment was in 2020, which adds a lot more to what their cost is, their carrying cost on that property. And given what I said about 60 to 70% of the first 5 years going towards interest, they haven't chipped away too much of that principal. So they have a large mortgage coming up for a pretty hefty renewal, again, at 4 to 4.5 times higher than what it was in 2020.
My gosh, these poor people. And what's your sense on how these risks may actually impact real estate investments and the broader financial market? Do you think it's positive or negative? What's your sense?
I think it could go both ways. Again, depends when people enter and exit the market. So if we're talking about people that are currently in the market, maybe looking to exit, where I see it affecting the broader market is we had a lot of investors that at the end of the day, they were getting virtually free money. So they were taking out big mortgages, big home equity line of credits, and a lot of the smart investors were taking that money and putting it into the stock market, ETFs, even high-paying GICs. So what I see is that, okay, my mortgage is up for renewal now. Here's my opportunity to pay down my mortgage, and my renewal rate's 4% higher. Let me go and cash in those investments, because stock market, besides a couple of weeks ago, we've seen a little bit of a dip, is performing pretty well right now. So let me cash out high and let me go pay down my mortgage. And that's what we're seeing right now, even with our own internal fund. We have some people right now looking at, should I pay down my mortgage or should I leave my money invested with your current rate to see what our returns are going to be versus the payment they're going to be paying on their mortgage. So I feel like on the broader market, that's where you might see a dip, as again, 1.4 trillion is coming up for renewal. And many of these investors were using the equity on their homes to make other investments. Now, On the positive side, for newer funds or newer REITs that have their ETFs available, I see it as a great opportunity, as they might be coming into the lower end of the market for purchasing some properties at a pretty good price. Because again, unfortunately, when these rates rise, you might have people that aren't able to make these payments, and they're gonna have to let go of these properties. And sometimes it might be at a break-even point. So that might be a great entry point for these newer funds or these newer REITs looking to acquire more properties to give a higher return to their investors.
Well, I mean, we've seen such a up and down rainbow colored markets over this summer. That's not actually usual. I mean, usually August is quite quiet. So yeah, you're right. It's been in the green for at least this week so far, and to end last week. So that's a really good insight. So tell us, who is most at risk for fixed or for the variable mortgage holders?
Yeah, of course. So the good thing is 75% of Canadians hold a fixed mortgage. So why I'm saying that's a good thing is because when it comes to the renewal, at least they know exactly what their mortgage balance is going to be. Now, 25% are variable mortgage holders. And within those variable mortgage holders, there's two different variable options. You have the variable mortgage rate, or the adjustable mortgage rate. So the adjustable mortgage rate, which I actually prefer in times like this, is a lot better, because what that means is as the rates were rising, your mortgage payment was rising. So let's say you get a mortgage at 1.8% with a 30-year amortization, and it's an adjustable variable mortgage. Your payment was rising and your amortization was staying the same. Now, who's at risk were the ones that took a variable mortgage, where that means that the rate was staying the same, their payment was staying the same, their amortization was growing. So if you got a mortgage and your mortgage was at $2,000 a month at a 1.8% with a 30-year amortization, and the rate went up to 4%, your payment stayed at $2,000, but you actually went into what's called negative amortization. So your amortization increased to 80, 90, 100 years. And that's what I'm seeing with clients right now. And that's the biggest fear right now for some of our clients that are renewing, because if their property didn't gain any equity, which we're not seeing right now as the market's taking a dip, they're not able to increase their mortgage. Also, let's say their property gained equity and we could add on a larger mortgage to bring in close the gap on that amortization. If they can't get approved for it, we can't get them for them either. So what's happening is the banks are actually doing cash calls, is what I like to call it, where they're sending you a letter and saying, hey, Lindsay, you're at 90-year amortization, your renewal's coming up, and we could only do 30-year because that's what the bank offers. You need to close a 60-year gap. We need to do a cash call of 20, 30, 40. I've seen one as high as $80,000. And they're only giving 60 to 90 days to pay it.
That is incredible. Wow. And I know that investors need to consider a slew of things when evaluating the stability and risk profiles of their mortgage-backed securities and their real estate portfolios. So from your side, what are your top two pieces of advice right now?
Yeah, my first piece of advice is definitely, like you said, assessing your whole portfolio, because when it comes to the stock market and the housing market, some people think it's completely separate things. I have some investors like, I just play with the stocks, and I have some that say I just play with real estate. But funny enough, it does affect as an overall, because what's happening in the stock world is happening in the housing market. Funny enough, if you look at the history, it's actually sort of a negative inverse every time. But again, like I mentioned when we started this conversation, this is the first time in history we're seeing something like this. We're seeing the stock market, like you said, it's a slew of rainbow colors in August, which usually it's typically slow. And we're seeing a huge fluctuation where rates are dropping down, buyers are excited, but also the ones renewing and owning properties are worried. So that's my first piece of advice, is speaking with your financial advisor, financial planner, but not just going over your investments and your equities and all that, but also going over the real estate and other assets you own to really understand your whole financial picture. And then the second piece of advice I have is, if you're currently a homeowner or a property investor, whether it's in a REIT or rental properties, I would speak with a mortgage broker or a mortgage advisor to understand what are your next steps to get ahead of the game. Don't just wait for that call saying, hey, you're up for renewal in 4 months. I would get ahead of the game, even if your renewal is in 2026 or 2027, to see how you can mitigate your risk right now. And anybody that's investing in any real estate ETFs or stocks like your REIT, again, I would ask for an assessment of their portfolio as well to see, okay, what mortgages are coming up for renewal in their portfolios. Because again, that matters for how that REIT is going to perform. Because if their renewal rate is going to go from a 2% to 4 or 5%, and again, sometimes it's in commercial mortgages as well, which is even higher, they might have to increase their rent. And what are the odds they're going to be able to increase their rent? Well, if they're Ontario like we are, it's slim to none. The courts are backed up with a lot of tenants not paying their rent. And also you want to see, okay, what is their cash flow going to be like when their mortgage increases by 4 or 5% in the upcoming year.
So this is a buyer's market. Well, here in BC anyways, they keep saying it is a buyer's market here, which, for all of those homeowners right now that won't be able to increase their rent, that won't be able to pay their mortgages, I guess that is a good thing that it's a buyer's market because they do have eyes on the properties. But it all comes down to a good strategy. So what is one that you are giving to your clients to mitigate risks and optimize returns in light of upcoming mortgage renewals?
The one I'm giving right now to my clients is looking at all the current debt that they have and looking at it as bad debt or good debt. But thinking of the bad debt as not bad debt that's written off or at a high rate or you're not going to pay off, as in bad debt that's what's at your highest interest rate. Is it credit cards, unsecured line of credits, loans, or even mortgages? And then again, looking at whatever assets they have to say, okay, instead of selling off your whole stock portfolio, let's sell a small chunk here to take care of this bad debt that fluctuates way too much. And let's just take on any good debt, which would be a home equity line of credit or a mortgage. So again, assessing your assets and your liabilities and understanding what makes sense and what doesn't. Sometimes for our clients right now, it makes sense that they sell high as the market may be, again, it's a buyer's market, but I still think we might see an uptick given the rate cuts that we're potentially going to have September 4th and the other one coming in October. So they might be able to get a good bang for their buck on their property, and then again mitigate that risk and hold on to that money, maybe rent a property for a year or 2 years and then look at where they reinvest it. I had a client this morning, we were speaking about that. He's heavily invested in the stock market and a bit into our fund, and he said to me, he's like, should I buy a property right now? See for sale signs everywhere. And I told him, I said, myself personally, again, it's all personal preference to everybody, I said I'm waiting because I feel like the effects of 2025 and 2026, we're really going to see some really good deals in the real estate market.
This has been great and it's so useful. Always remember, to all of our investors, your risk tolerance. Always make sure that you are assessing your portfolio based on your risk comfort zone. Thank you for chatting with me again, Michael. It's always a pleasure.
Thank you for having me. I'm always happy to speak.
Again, that was Michael Sakuro, CEO of Fluent Capital Management. To join the conversation, head to stockhouse.com. I'm Lindsay Melchak. We'll see you next time.